Hi everybody, this is Tony Angelo from the Paragon Trust Company in New Haven, Connecticut. I'd like to talk to you today about tax traps to avoid with retirement distributions. There is a very good article in the Bottom Line Weekly by Ed Slott, CPA, an expert in this field, concerning this, and I thought I would discuss it with you. Tax-deferred retirement plans such as IRAs and 401ks are a great way to build a sizable nest egg. However, there are a few things you need to know in order to avoid sizable penalties. When it comes to withdrawals, any withdrawal before the age of 59 and a half years usually triggers a 10% penalty. There are some loopholes, however, such as death or disability. If you retire or change jobs after the year you hit 55, you can withdraw money from an employer-sponsored plan. You can also take substantially equal periodic payments penalty-free for at least 5 years or until age 59 and a half, whichever comes later. A word of caution here in that the rules are very complex, so work with a qualified tax professional. Here is a trap, however. If you don't start to take required minimum distributions known as RMDs by April 1st of the year you reach age 70 and a half, you could face a 50% penalty. Once you reach 70 and a half, you must take the RMDs and pay tax on it as long as you are alive and there is money in the account. You can always take larger withdrawals if you want. Here is another loophole for you. There are no lifetime RMDs for Roth IRAs, and you do not need to take required distributions at age 70 and a half if you are still working, as long as you do not own more than 5% of your company. However, you must continue to take RMDs from any other plans and IRAs. One strategy: if you are working after the age of 70 and a half, see if you can roll your IRA into your employer's plan, if possible. This way you will forego having to take distributions and avoid the 50% penalty. How about that? Taking 5% from your retirement plan each year is fine if you need the money. However, if you do not need the income and you withdraw more than the minimum, you will be paying more income tax than you need to pay sooner than you need to pay it. If you do not need the money for bare living expenses, withdraw only the bare minimum. Lastly, name a beneficiary. If you do not, whosoever inherits your account will have to withdraw more money sooner and pay more income tax. Possibly set up a trust and then have beneficiaries being your heirs of this trust. If this is done properly, and many times it isn't from one in the field, setting up a trust can permit your heirs to stretch out required withdrawal amounts. Work here with experienced trust professionals, and I can't overemphasize that enough. Well, I hope you found that helpful, and we'll have more on subjects like this in the days to come. This is Tony Angelo of the Paragon Trust Company in New Haven, Connecticut, and you can reach me at 203-777-7334. That's 203-777-7334, or at fortresstrust@aol.com. Have a great day, and have it right here on Gatewave Radio.